Time for Hot Picks. Our guest is focused on large caps that pay dividends, and he recently added Honeywell International to his list, and in fact, that's his top pick. We're joined by Greiner, Senior Portfolio Manager at FM Investments. Christian, thanks very much for giving us the time.
Thanks for having me this morning.
Start off with Honeywell International, please. What attracts you to that stock?
Well, for us, this was a recent purchase for our portfolio. When we're in times like these within the market, we see investors really want to get a nice dividend yield as well as earnings growth, and Honeywell is kind of the test case for this, of how you can get this. We were watching them. We're looking for free cash flow growth to support that dividend. And, we saw after a couple of years of decline, we were going to get an inflection point with them. Part of it is their new CEO, Vimal Kapur. He's been on the job for about 18 months. He's made some pretty well-received portfolio moves. He's got out of non-core businesses like PP&E post-COVID. And they've put capital towards liquefied natural gas space, building automation. But what has really captured the headlines, of course, is that Honeywell for a long time has been the last of the conglomerates. And they're finally going to be doing a breakup move similar to what GE did a few years back. And they've, for them, they'll be unlocking shareholder value by breaking into three smaller entities: aerospace, advanced materials, automation. The dust is expected to settle on this in the second half of 2026. And once this happens, there's an argument to be made that they're going to be getting rid of about a 20% conglomerate discount that should once again help unlock shareholder value.
The yield not huge, just over 2%, but the company has been regularly increasing the dividend.
Yeah, so it is a dividend aristocrat, as people like to call it. And what we see with them is we want to see a good earnings report and a relatively conservative guide, and that's what we got yesterday from them. They also, of course, talked to us a little bit about what the tariff exposure would be, and they believe that they can offset it through pricing action. So when we take a look at the entire package for the stock here, it's trading at below a 19 forward PE, so it's slightly cheaper than its peer group. Those dividends are growing at a 5% rate, and there is further upside when you start taking a look at the balance sheet for capital return for shareholders as that free cash flow grows.
Your next idea is a banker based in Pittsburgh, PNC Financial, yield about 4%.
Yeah, so going into the earnings season for banks, banks were down about 20% on the month before going into the earnings season, and when you see that in an industry, you're looking for opportunities, and PNC is one of those opportunities here. Tariff uncertainty, of course, is going to hurt banks as well. Commercial clients curtail their investment plans. A slowing economy hurts consumers. They pull back on their credit cards, and we might, of course, see higher delinquencies. But this is a bank that has a really strong management team. They have a proven history of managing interest rate risk as well as credit risk here. And one of the unappreciated things for them is that they have a more durable fee-generating business. Think of things like treasury management, capital markets, asset management. Their asset management business was pretty good this quarter. It had positive net flows. And treasury management's about 20% of their revenues.
And then finally, a company in healthcare, Abbvie, biopharmaceuticals, a yield of about 3.4%.
Yeah, so for our portfolio, this has kind of been our nexus of growth in earnings as well as a healthy dividend for a couple of years now. And Abbvie allows our portfolio to be exposed to high teens earnings growth. You're collecting about a 3.4% dividend. That's nothing to sneeze at here. And that's been growing at about 7% over the last 5 years. Their latest earnings report was the kind of classic beat and raise. But this is why investors have been looking at healthcare and other less economically sensitive sectors in 2025, as you can see today. For them, when we take a look at what is driving these earnings, their immunology division continues to be a big driver of performance. Skyrizi, Rinvoq, for them, they're taking market share in a number of areas within immunology. Think of like Crohn's disease. A lot of doctors like the safety profile of these two drugs. The other part that might not exactly be well appreciated is neuroscience franchise. It's growing almost as quickly as their immunology division. Think of things like the therapeutic use of Botox for migraines or a spastic neck. And about the only part of weakness we saw with them was what we expected, and that's the aesthetics portfolio. So think of Botox Cosmetics as well as Juvederm fillers. That missed this quarter, but with everything going on with macro, you kind of expect that.
We'd better jump. Thank you very much, Christian. You gave us some ideas there. Really appreciate it.
Thanks very much for having me.
Christian Greiner, Senior Portfolio Manager at FM Investments.